It will be devastating. I'm your host, Steve Van Metre, and thanks for joining me today. And famed economist Nouriel Roubini, better known as Dr. Doom, is back in the news, this time saying the upcoming recession, which is a foregone conclusion in his mind, will be severe and affect every American household. The question we should address in today's show is, how does he know that a recession is indeed a foregone conclusion? Why should it be severe? Is it just because the last two were very severe and led to big drops in the stock market? What are signs he's looking at? Because when you start to understand our monetary system and our financial system, that our economy is based on the expansion of debt, when you have rapid and large increases in debt and that are not followed through by a continued expansion of the economy, well, the probabilities start to rise that the next recession will lead to something in terms we'll see the word crisis involved. But the question we're going to ask is Roubini right, or is he just living up to his moniker, Dr. Doom? Let's over to Business Insider, where we pick today's story up with the headline, Dr. Doom economist Nouriel Roubini says the world is on a slow motion train wreck while warning a U.S. recession is a sure thing. He warned that a mix of inflation, artificial intelligence, climate change, and the risk of World War III all stand to have enormous global impacts. No doubt any one of them could. We must learn to live on high alert, he said, adding, we will need luck, global cooperation, and almost unprecedented economic growth for a positive outcome. And let's address the last part of what he says here. We need global cooperation. And this is absolutely true because we're still in the early stages of what is a budding global economy where everybody's starting to learn to work together. And what we have is some actors who don't want to work with other people, some that do, some that don't even know how. But as we evolve and grow and come together, it is going to take global cooperation for this to happen. And if we are able to achieve that, well, we'll get that economic growth that Roubini says we desperately need. Expanding on his downbeat predictions for the next year, Roubini slammed the Federal Reserve for missing the mark on inflation, warning there's a sure chance the economy will tip into a recession as a result of the U.S. Central Bank's aggressive interest rate increases. And he's got a good point here because when we were getting all of this fiscal stimulus from the government, the Fed made what will be in textbooks for decades to come one of the biggest policy mistakes a central bank can make, and that was ease and keep monetary policy easing at a time of unprecedentedly large fiscal stimulus. The Fed had an opportunity to increase rates then, to unwind its balance sheet at the time, and it did the exact opposite. And with the combination of fiscal and monetary stimulus, well, we got a big balloon of inflation. And we know throughout history, when inflation gets out of control, when that genie gets out of the bottle, well, there's something that follows. It's called a recession. And here you can see, looking at the consumer price index on a year-over-year rate of change throughout history, you can see with almost rare exception, big increases in the CPI, you notice are followed by this gray shaded area, which means a recession. And here you can see one time it didn't happen, but over and over again, you note multiple points where inflation is run up, and then all of a sudden you get a recession, suggesting we might already actually be in a recession now, or we are indeed very, very close to it. But what are some things that we're seeing in terms of the Federal Reserve and making a policy mistake here, being too late to the inflation game? Well, we can note, we talked about the Philly Fed data the other day. Let's go back to that and look at how the Fed's having an impact on the manufacturing sector. So what we see here is current new orders from the Philly Fed, a regional Fed survey against the federal funds rate in red. And what we can note is in periods, usually when the Fed is raising rates, you see new orders. And I know this line's all over the place. And that's simply because of the noise from the federal, these regional Fed surveys. But you'll note that it leads to a slowdown in new order growth. And while higher rates do not directly impact new orders in that sense, what they do impact is the debt. It impacts how people spend their money. So if they're in a period where they have high debt loads and the servicing cost because of higher interest rates goes up, it means they have less money to spend on discretionary goods. So what we're seeing here now in that chart is the Fed aggressively raising rates. You can see coming back a collapse in new orders, which is normally associated with the period where the Fed is easing rates. So the Fed here indeed is making a huge policy mistake. And we can add on to that, it's at a time again where we have a massive debt load. So you talk about how do we know that a recession is coming and a financial crisis is likely. You can see throughout history here, you note that total consumer credit owned and securitized is just off the charts. It's expanded, but that's what you should see in a debt-based economy. But you'll note when the Fed is raising rates, it starts to put a dent into that. It has an impact of causing a recession, because when you slow down the amount of debt that's needed to keep the economy fueling, well, it leads to a recession. The worst part that happens is when you increase the interest rates too much and you cause people to lose their jobs. Well, that leads to a collapse in debt as delinquencies and insolvencies start to occur, and that's not what you really want to see. But the Fed is on that trajectory now, which is how we know that a recession is the likely case and a financial crisis has a high probability of happening. The conventional wisdom coming from policymakers or Wall Street has been systematically wrong. First, they said inflation is going to be transitory, which I will say it is, and I'll show you here shortly that it will be. Then there was a debate over whether rising inflation was due to bad policies or bad luck. And there's no doubt in my mind, and maybe in yours, that we saw this rise in the consumer price index due to an unprecedented amount of fiscal and monetary stimulus at a time the global economy was shut down. So all of a sudden you had all this inventory on shelves, you fund people with a lot of money, they clear the shelves to the point where they still have money, they still want to spend, but factories around the world, businesses were completely shut down, and as they tried to reopen due to supply chain constraints, it led to runaway inflation. Now that's all coming back under control, but it is slow. It is a very slow process. But there is one thing that is systematically right, and I want to mention, because I told you I was going to send the data over to the programmer. I did. He's going to work on it over the holidays, and that is CTA-Timer Pro. Again, it's at $20 a month. It's going to go to $100 as soon as he's done with the updated version, and we do a guidebook. But if you want to track historically how the machines would function in the market, moving up and down, you want something to help you time the markets. Here you can see the S&P 500 and NASDAQ is showing how historically the models would actually be selling into the weakness here recently. Grab this at the link in the description. Again, it's going to $100 as soon as he's done. He tells me probably next week. So again, lock that price in. But now let's look at the probability that we see inflation coming down. Again, link in the description for CTA-Timer Pro below. Here you have the consumer price index for all urban consumers, again in blue on a year-over-year rate of change. And now we've got the 10-year, 3-month yield curve shown inverted. And here's the inversion line. So when it's above the yellow line, we see that it is inverted. And what can we note? That periods of inversion lead the consumer price index down. And here you can see inversion, consumer prices coming down. Inversion, there was a transitory increase here due to oil prices, and then inflation came crashing down. Here you can see just a point where it wasn't even inverted, but the yield curve came down, inflation down, inversion, inflation down, inversion, telling us inflation is indeed coming down. And again, transitory in the terms of the macro world, it is indeed going to be transitory, and we'll see that in the months that come as we see the consumer price index head lower. Rubini warned that the oncoming economic downturn will be severe. He said, no, this is not going to be short and shallow. It's going to be deep and protracted. And again, this all comes back to debt. You have too much debt. You put people on the unemployment line. They can't afford to make their debt payments. They have delinquencies. They lead to defaults. And then that is where you see the collapse happen. We're going to look at another factor here. We see it in the news here in a little bit, but that is the issue. That's how you know it's not going to just be a regular recession versus a crisis, because if everyone would have taken those fiscal stimulus checks and either saved them or paid down on their debt, then we'd be talking about just a garden variety recession instead of an outright crisis. Dr. Doom goes on to say with U.S. inflation at 7.1% and employment at 3.7%, he cautioned the world's largest economy will almost certainly face a hard landing because the key part here is inflation is going to come down and unemployment is going to go up, and that will lead to that hard landing. He also sounded the alarm earlier this month on a potential stock market losses given the likelihood of a U.S. recession. He predicted the S&P 500 would crash as much as 25% if the economy contracts next year, making it even more bearish than Michael Wilson, as we talked about the other day, of Morgan Stanley, who said he thinks we could see a 20% drop. But when we look at not just the stock market, the unemployment change that are all going to come with a recession, there is one factor that a lot of people say isn't going to impact anyone because it can't happen, and that is the housing market can't go down. But we're seeing in the data right now to suggest that we're at the early stages that the housing market is going to come down. In addition, when we talk about those used car prices falling and people stop making payments on their cars, well, guess what's going to happen in the housing market when people lose their job and they start to see the value of their house is tumbling down. As U.S. housing starts permits fall on slide in single-family homes as total new construction slips 0.5%, marking the third straight drop, and permits also heading lower too. The sustained slide in new construction underscores how this year's surge in mortgage rates has stifled buyer demand and weighed on broader housing market. Meantime, high costs for labor and construction materials have made it even more challenging for builders to preserve margins while employing incentives to lure buyers. And this is what people don't realize is they are competing with builders. They have inventory, they have excess inventory, and when they can't sell it, they'll cut their price. When they cut, well, guess what happens in the resale market? Prices come down. And home builder sentiment has fallen every month this year, a leading indicator that home builders will be slashing prices, dropping in December to the lowest level in over a decade outside the onset of the pandemic. And weaker demand conditions have led to nearly 2/3 of builders, here it is, to offer incentives to lure buyers like mortgage rate buydown and paying points for buyers, which is the beginning stages of what will then be price cuts. And you can see that in these next two charts. Here you can see home buyer confidence from the University of Michigan leading home builder confidence, and builders are still remaining optimistic, but I have a hunch in the months to come that this green line is going to come crashing down. And when we look at the National Association of Home Builders traffic here in blue, it's leading home builders present sales in red and future sales in gold, suggesting that home builders will have no choice but to cut back building and slash prices. And we're already now seeing signs that the resale market is seeing demand crash. As U.S. previously owned home sales weaken further as high rates take toll. As contract closings slid 7.7%, get this, the biggest drop since February. The drop in sales, which extended the longest string of declines dated back to 1999, underscores how high mortgage rates continue to crimp demand. The ensuing pullback in home prices in some areas, paired with high borrowing costs, have also kept many Americans from listing their homes, further limiting sales. But wait till people start losing their jobs. They'll be forced to sell their homes at a time there isn't a lot of demand. And when you see that happen, there's only one thing you can do with price to bring demand up, and that's lower it. The residential real estate market was frozen in November, resembling the sales activity seen during the COVID-19 economic lockdowns in 2020. The principal factor was a rapid increase in mortgage rates, which hurt housing affordability and reduced incentives for homeowners to list their homes. And you can see if November is frozen, what's going to happen in December, January, February, March? If that's the beginning of a trend, now we know that perhaps Dr. Doom isn't just being doomish. Well, he's being real. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.